David Weaver, Megan Wallen, Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North, State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm. It's now time for User-Friendly Finance with Dave Weaver from SWC Wealth Management on News Radio, WHP 580. If you have a question for Dave, call 540-0580. Now with today's show, here's Dave Weaver.
Hi, good morning. This is Dave Weaver with SWC Wealth Management and User-Friendly Finance, another issue as we're trying to go through the various things that might affect you in your personal financial life. And we've started today. Joining me is Tom Pop. Good morning, Tom.
Morning. Happy Sunday.
Happy Sunday. Yep,
Nice.
Every day's Sunday. So we started talking about what we call the 8 wealth management issues, 8 things that can affect your personal financial life that we try to go through with our clients, maybe cover one of those issues in each meeting. And we're going through and trying to help people understand how those impact their lives, how you might start to work with your own personal financial advisor if you don't have one, and try to get your own personal financial house in order. Just a little bit about SWC Wealth Management before we get started. We have 2 offices. We're in Palmyra and Carlisle. In Palmyra, we're at 103 West Main Street. Our primary telephone number is 717-706-0700. But you can reach us for our Palmyra or Carlisle office by calling that number. In Carlisle, we're at 35 East High Street. And both of those offices are about a block off the square, very easy to find. And our office hours are normal business hours, but we have appointments on weekends and evenings as they're required. So if you want to get in touch with us, if you have any questions after the show, if you just want to have us review your personal financial situation, or if you feel like whoever's preparing your taxes doesn't understand your investments, or whoever's doing your investments doesn't understand your taxes, feel free to give us a call. We can help try to improve your situation from a tax and investment standpoint. So as I mentioned, we're going through what we call the 8 wealth management issues. Tom, why don't we try to go through those, just list them, and then we'll go back and target in on this week's subject, which is going to be life insurance. A lot of people don't like the subject of life insurance. Some people find it a taboo subject to even talk about. And
It's difficult, but it's important. As Dave mentioned, we take a holistic approach to our financial planning, and part of that approach involves addressing the 8 wealth management issues. So the first one that we typically look at is investment management. That takes up a large portion of our practice and our business, but it simply means reviewing your stocks, bonds, mutual funds, anything that's investment related.
And honestly, in our client meetings, investment management turns out to be a portion of the meeting.
It's more of our behind the scenes.
Yeah, it's behind the scenes because we try to focus on the other aspects of your life.
Right.
Anybody really, people think that anybody can do investment management. You can anymore. If you have a 401k, they may have portfolios that are targeted to your retirement date or whatever. But sometimes those are effective, sometimes those are not. But there's more to investment management than that. But we try to we try not to have our clients have them have to feel like they have to know everything about investments. We try to educate them and inform them, and we will try to develop portfolios that match their risk tolerance.
Mm-hmm.
But it's like I said, or like Tom said, it's kind of behind the scenes. It's probably 20% of our quarterly meetings when we meet with clients is investment performance, because the other aspects of your life are just as important. So anyway, that was the first issue.
That's a good point. I guess I shouldn't have said it's the major portion of our business. It's just tied to a lot of what we do.
Yeah, tied to a lot of what we do. And that's what people think of us first. People, when they, oh no, I'm in financial trouble, they think first about their investments. They may not be thinking about all the other aspects of their life. Don't even know they have problems.
Right. It's true. That's part of the process. Cash flow and debt management is the foundation for your financial plan that's coming up with a budget. It's figuring out what comes in and what goes out, and trying to manage, keep a manageable debt level, if any at all. The third area is family risk management. We're going to talk about that today for insurance. Insurance planning, it could be long-term care, disability, and life insurance. And then the fourth one is also, I would say, a major part of our practice is retirement planning. I mean, that's a huge portion of your financial picture, is trying to figure out how you can convert those assets that you've accumulated over your life and turn them into a comfortable retirement income stream.
Yeah, you work. You work 30 years for retirement. You want it to be what you want it to be, and you want to make sure that your plan matches what your expectations are. So the other areas that we have that are part of the 8 wealth management issues, and we'll get to those in subsequent weeks, are education planning, which is planning for your children or grandchildren's education needs. Legacy planning, which in our world is typically estate kind of planning. What kind of assets do you want to pass on to your kids? What kind of whole legacy do you want to leave behind when you pass? And business planning, that has to do with a bunch of different things: business retirement plans, business insurance. Not so much how you run your business, but just how you protect your business. And then special needs are things like things that you may want to purchase in the future, such as maybe a pool or a house at the beach. So there's a whole variety of things that you may want to have a plan to try to create somewhere in your future, and it takes money to have that happen, and somehow you want to make sure you stay focused on that. If a house at the beach is your primary goal, it doesn't just pop up and you start going every weekend. You have to plan and save.
For it.
Yep. Okay, so today our subject is life insurance. What do you think are the two basic forms of insurance, Tom, for life insurance? Oh, by the way, we talked, you weren't here last week, Tom, but we talked all about long-term care and the disability insurance.
Yeah, and those are
like
all
that.
part of the risk management
Right,
area.
family risk management, right?
Yeah, the main types of life insurance that we work with are really the primary types are term insurance and permanent insurance. And
that's changed. Back in the day, almost everybody had whole life
of some sort.
Yeah.
And essentially, depending upon your situation and what you're looking to achieve, you can accomplish that through either one of those. Term insurance, it lasts for a specific amount of time. You're paying premiums that are only covering the cost of insurance, so there's no accumulation value or cash value. And it's typically the least expensive form of insurance. And then permanent insurance, you get into whole life, universal variable, and so on. So there's a couple different types that can get kind of confusing for people. But that is typically, I guess, the main difference between term and whole life is whole life, or permanent, I should say, will last and should last throughout your whole lifetime. And also has that cash portion or investments as well as the cost of insurance, which in return makes it a little bit more expensive than term. But there is the, and this is kind of confusing when I say this.
And I think permanent insurance is what back in the day was sold very heavily up until probably the 90s or around 2000. I don't remember what year exactly, but somewhere between 1990 and 2000. Terms started becoming more and more acceptable.
Popular. Yeah, you have different years. You have 10, 20, 30 years what you can cover. And it's interesting we say sometimes that term insurance is the most expensive, but it's also
the least expensive,
but it also the most costly. And it doesn't really seem to make sense, but when you think about it, you're paying premiums all towards the cost of insurance. If you live past that term, there's no residual value for anybody.
Right.
So the insurance company wins. However, whole life, a benefit will eventually hit somebody.
Right.
So even though it's costing you more, you're actually receiving a benefit.
Right.
So that makes sense.
Yeah, that does make sense. With that, we'll take a break. We'll come back. We're on the subject of life insurance this week. Again, one of the aspects of our 8 wealth management issues. If you have any questions, if you have thoughts on life insurance, give us a call at 717-540-0580 or 800-724-5801. We'll be back right after the break. What the heck is that, Art?
That's Billy Idol.
Billy Idol? Oh, my heavens. This is Dave Weaver and Tom Pop, and we're on the subject of life insurance, so a little Billy Idol can't hurt anything on a Sunday morning. Um, we're talking about the subject again of life insurance, and we're going through our eight wealth management issues. Again, SWC Wealth Management. The eight wealth management issues are just a way that we use to try to talk to clients about their financial situation and make sure we're taking a holistic view of their finances, so that back to our the concept of true north that we've been talking about. There are many aspects of your life, and one of the things that you worry about is how do you take care of your family in the event that something happens to you. And that's where we started talking about what are the two primary means of life insurance at this point. And they're typically you look at whole life or term, and we'll get to those probably after the next break. But in the meantime, we wanted to talk before we got to that about how do you figure out how much life insurance you need. And this is something that's I don't know if I guess it's debatable. It's
there's all different kinds of formulas you can use, but I mean there's a few I think rules of thumb that are good to abide by, and we certainly like to work with clients to help come up with that number. So
I guess the things that you want to try to cover. We looked at one article that called it the dime rule, which is debt and final expenses. Add up your debts and other than your mortgage plus an estimate of your funeral expenses. Your income, decide how many years your family would need support and multiply your income by that number. The multiplier might be the number before your youngest child graduates from high school, and use that calculator to determine your income replacement needs. Then paying off your mortgage, and then education, estimate the cost of sending your kids to college. That is a lot for people to take in, and it's a big number when you
add it all up. You could say, "Whoa, okay."
So if we kind of take those individually, the one people typically associate with life insurance is just paying for your funeral. The funeral is a small part of what happens if you pass, particularly for young couples. If you're we meet a lot of younger couples that don't have really appropriate life insurance even to cover their mortgage, because they look at the cost and decide that it's not, it may not be worth the cost of doing it, but the cost is really inexpensive.
It really is.
I think they heard that life insurance is expensive.
Well, yeah, if you're buying term, it certainly is. And for a younger person, and you think about it, you insure your car, you insure your house, you're the biggest asset you have in terms of producing income throughout your life for your family. So why don't you insure that?
Yeah, so you want to make sure, this is where we come back to the True North concept in a big way, which what happens to your family if something happens to you? And if we talk to the average couple, the average happy couple, they don't want to have their spouse or their family suffer in the event that something happens to them. You don't take a lot of time picturing life without yourself. Maybe some people do, but generally people don't think about that. But it is one of the things that if you take even 10 or 15 minutes, talk it over with your spouse and figure out what you think would happen in the event that something happens to the other person, that's when this stuff starts to come into play. People do have debts that they want to see that are paid off, and their mortgage, and they want their funerals paid off. But the ones that are a little harder to figure on are the income aspects of what we just talked about, and education. Like how much do you want to pay for your kids' education? And a lot of people on the surface will say, I want to make sure my kids can get to college or pay for college. So that number is a growing number. Even when we get to the subject of education planning, a four-year college now costs about $50,000 a year for a non-state school, or even for a state school, it's getting close to that. So you're talking about, at least $200,000 and maybe more like $400,000, or maybe even more if you escalate it for inflation. So what do you want to pay for, and is that something that's important to you? Back to your what you and your spouse's view is of what's important to your family.
Yep. And then also for older people that maybe their kids have grown, it's still important, I think, to have some form of insurance potentially. It can be used to help pay for equalizing an inheritance for a beneficiary, to pay taxes on that. There's a lot of different strategies that a whole life would then come into play, or permanent life, if you wanted it to go beyond your working years. So there's other aspects of it that some people don't consider as well.
Yeah, so those escalating ones are the cost of education and the income that your family's going to need to support their lifestyle over time. And I think, again, the average couple, or even, the average couple wants to make sure that their family gets taken care of in the event that something happens to them, and that they want that to happen over a long period of time. So,
and there's different income calculators that you can use. Some use 10 years, others 5 years. Usually, typically, a work policy will cover that as well. 2 to 5 years multiplier for income.
Most employers will offer some multiple of your salary for life insurance, but a lot of people don't have life insurance through work either, and those are the people that really don't have enough coverage.
And plus, if you leave your job, then that doesn't typically go with you. So it's always good to have an additional or supplemental to that as well. If you can blend the two, maybe use some from your employer and have an additional policy on the side that can help.
Yeah. So I guess the key to all that stuff is there are a lot of things you want to take into account for life insurance. Talk it over with your spouse. Make sure what you want to cover. You want to make sure that you're talking over with your spouse because both of you want it to make sense. It's a dollar amount that's coming out of both of your wallets. As to what Tom was saying, there might be some sense, particularly if you're looking at term insurance, which we'll get to in a couple minutes, where maybe you do multiple policies to cover different aspects of your needs. Maybe you have college, term insurance that covers up through the term of college. Maybe you have mortgage insurance, some kind of insurance that covers up to the length of your mortgage in the event that something happens to you. But maybe multiple policies instead of one large policy might be a way to do it. Again, you have to figure out, and we'll get to the discussion of term versus permanent. You have to decide if you have an ongoing need for life insurance, or you could actually, for some people, it turns out to be a plan for longer-term investment planning after you get past the point where you can't save via other vehicles. Life insurance, from a whole life standpoint, actually has a pretty high return on rate of return if you play it out over the long term and actually look at the policy. But it also comes with the burden of insurance over the top of it. So
right, there's a cost to it, but you can definitely leverage your money with it.
And there are a bunch of calculators on the internet if you go out there and try to look at what you've got. Again, you want to look at your mortgage balance as it is today and look at the length of period of time it runs. If you have any home equity lines, by the way, those aren't going to be deductible. Home equity lines starting in 2018 on your tax return. If you have personal loans, either through a relative or for some other thing that you borrowed money for, RVs or boats sometimes have loans, separate from your car loans. Student loans, if you still have those remaining, a lot of people have those remaining anymore.
Yes, a lot.
Yeah, so I don't know. I think the average kid now is graduating with something like close to $100,000 of student loan debt. You don't want to pass that on to your kids or to your spouse if something happens to you. If you owe tax money to the IRS, all those things may be a way to help you calculate it. But again, there are multiple calculators out there on the internet that you can look to try to find out what you need. And it's usually more than what you think. It's going to be, particularly for younger couples, if you take all those numbers into account, it's going to sound like a really big number. So between the husband and wife, you have to figure out how much insurance you want to provide for your family. Again, the goal is to try to keep your family as whole as possible in the event that something happens to one or the other spouse. And the fact that one of the spouses may be a at-home spouse not working doesn't mean that there's not a cost to having them, or a value to having them being at home that you want to cover in the event that something happens.
That's true.
So, and a lot of people forget that and just assume that you don't have to replace income because of that. It's not just income; it's the cost that you would incur if something happens to that stay-at-home spouse.
Yep, I agree with that.
So, I think with that, we'll go back to where I think that kind of gives us a groundwork to talk about term versus whole life. So those are the types of things you want to cover, and now we'll get back again to the hows of how you want to cover them. So with that, we'll take a break, and we'll come back and go back to the subject of term versus whole life. This is Dave Weaver and Tom Pop with User Friendly Finance. If you have any questions, feel free to give us a call here on the air, 540-0580 or 800-724-5801. Or if you have questions during the week, call us at the office at 717-706-0700, or you can reach us via the web at swcwealth.com. We'll be back right after the break. This is Dave Weaver and Tom Pop again with User Friendly Finance from SWC Wealth Management, and we're talking about the subject of life insurance. Again, a lot of people have strong opinions about life insurance, but it's something that you should be aware of, something that's important to your family and your family planning, and you just don't want to totally ignore the subject, even though it may be something you don't like talking about.
Yeah, it's
maybe that's part of the. I think the big problem with life insurance is back before 2000, probably it was very heavily pushed by life insurance salespeople, and that was. I think something that gave insurance people kind of a bad feeling about it. And over time, the discussion about term versus whole life has really gotten to the point where, the term is definitely a lower cost version of insurance, and it doesn't stay permanently. So it comes and it goes, and you lose what you put in, but whole life insurance stays, but it's more expensive. I don't know if it's similar to comparing like a smart car with a Cadillac, with all the features, because the Cadillac that has all the features doesn't run forever, but it is a higher, it has more ways to be able to utilize it than what you can get with term insurance.
Yep.
So,
and I don't know, I've been more of my personal, for me, is more of a buy term and invest the difference, and that's another strategy some people do.
Yeah, and that's something that, we'll get into that as we talk about the difference in the cost. And it's a good strategy. The problem we've always had is people don't never invest the difference. So it's a good strategy if you know what your needs are, and that we walk through some of how you calculate what that total need is. Well, let's say it's $400,000 or $500,000. Let's say it's $500,000, and you can get term insurance that will pay for that over time. Whole life would maybe cover that permanently. But and there's a difference in the cost. Will you take that? If people see the difference, will they take that difference and invest
invest it?
Yeah, that's really the question. But it's I think that'll become clearer as we talk through the difference. Okay. So term is typically available in what lengths, Tom?
10, 20, and 30 years.
Okay. Yeah, and there's in between years
and
too.
some in between as well.
Yeah, 15 and 25. Yeah, you can get it all kinds of increments.
But typically, when we're running quotes, it's 10, 20, 30. But obviously it depends. Yeah, you can make it depending upon what your need would be. So
yeah, and when you're buying term, there are some of the policies are level and some are not level. What that means is that the term you pay, let's say you have a 10-year period that you're covered in like a term policy that has a renewable rate, every year you're paying a different rate based on your life expectancy. So that's typically that's the way the insurance companies are doing. They have actuaries that figure out what your probability of living is, and then they figure out a cost to cover that amount. And the majority of people don't pass away during that time. Some do. That's how they pay for the term life insurance.
Yeah, and with to that point on the actuarial side of things, this mostly applies to whole life. They have adjusted. We've done policy reviews because they've adjusted those tables because people are living longer. So if you have an older policy, we might be able to look at it and find a way where you can either pay less for the same amount or get more for the amount that you have, or use the cash value to make up the difference because the policy was written back before.
Yeah, I think it was around
2000.
Yeah, it was around 2000 that they changed the life expectancy, and because people are living longer.
And they're going to probably change it again too. So there's ways we can help people with that. Sorry to sidetrack.
Yeah, they may change. They may change it down for women.
Right.
Because women are actually living less long.
Yeah, I read that too.
Yeah. So Okay, so when you're typically purchasing life insurance, we almost always quote a level term because people don't like the fact that their rates can go up, but you can get it either way. So it can be either variable or fixed for the specific period of time that you want for the amount of money that you're trying to cover. At the end of the term, sometimes you're able to convert that policy to a permanent policy, but that premium will typically jump. I just had a 10-year policy that just expired, and the rate went from I think it was $244 a month to $1241 a month.
Quite a jump.
It was a big jump for a life insurance policy, and that's typically what happens if you get to the end of the term and they're converting it to another, like a more permanent policy, and that's typically what they do. They don't typically extend the term as a term insurance. They extend it as a whole life policy at that point.
And then you don't have to go through the insurability process again.
Yeah, that's one thing we didn't really cover, and I don't think we covered it when we talked last week about long-term care insurance. And long-term care insurance, they're trying to make sure that you don't have something that will cause you to be need care for a long period of time. And life insurance, they're looking for things that may cause you to pass early.
Right.
So
get different rates based on that.
yeah. So when you go to, and we probably should have talked about this up front maybe, but the things about life insurance are things that may keep you from getting life insurance are cancer, heart attacks, or things like that. Typically, for an average person that's in good health, you go in, you do blood work, they'll take a look at your medical records, and based on that, they'll decide whether you're an average risk or maybe a slightly above risk. If you're a smoker, you may not be able to qualify for life insurance, or you'll qualify but maybe at a higher rate. There's a whole series of variables that they look at to try to determine your life expectancy. When they do that, that all goes into a table that's kept across it's a national database that's used by all the insurance companies. If you don't qualify, that'll be there for the next insurance company that goes to look to see if you're eligible. But again, they're looking to see how, if you have something that's going to cause you to maybe not outlive your policy before they issue the policy. And it does mean that they won't accept you, but they may accept you, but at a higher rate.
Right, and they've got all different types of language for that. It could be preferred or preferred plus or standard or whatever they might call it.
Yeah, a lot of different insurance companies use a lot of different tables, and typically you'll get quoted a standard rate or an average rate, and not a preferred rate. Preferred rate you have to be able to qualify for, and they won't know that till they actually get your medical and get it through underwriting.
Yeah, and that's what we usually do when we're quoting. We'll quote them at standard, and then hopefully it'll come out better, and you won't have as much to pay.
Yeah, unless we know that somebody's a smoker. That's
right.
That's always a catch one. Series typically cancer within the previous 3 to 5 years can cause problems with actually even getting in the life insurance.
Yeah. I think diabetes will probably get you table rated.
Right. Yeah. If you get the things in the mail that offer, virtually everybody gets it, or I forget what the wording of it is, where you'll see the ads where you have 3 questions. You have to qualify with 3 questions. I don't remember what all they are, but have you been to your doctor in the last 3 years for one of these 3 or 4 things, like liver disease, diabetes is one. There's 3 questions that they ask, and that's probably the simplest version of life insurance that there is. And they will check your medical records when you go to apply. It's not that they'll take your word for it and away you go. They will still check your medical records, particularly if you get insurance and you haven't answered those correctly. They could refuse to pay the policy if you haven't disclosed something that was available in your medical records. So life insurance is one area where you don't try to stretch the truth. A lot of people may think about stretching the truth with their tax return, which you shouldn't do either, but you don't want to do it on life insurance because you could get picked up later down the road. Okay, so we're still on the subject of term. There are some kinds of increasing and decreasing life insurance. A mortgage policy might be the most typical one of those, where you can get a policy that as your mortgage goes down, your premium goes down, or the amount of coverage that you have goes down. That's probably the most typical kind. Or if you have one that's trying to make sure your debt is covered when you pass, and sometimes those apply to like a car loan or something like that. They have life insurance associated with those. So you just want to think about all these things as you're trying to make the decision about life insurance. Next, we go to permanent, and I think that what's a good description of permanent, Tom? How does it differ from term?
It's a blanket term for life insurance plans that do not expire, unlike term. So they typically have two elements. You have the insurance cost area, or the insurance part, and then there's also savings and cash accumulation value as well. It's going to cost more money, obviously, because you're paying for the insurance throughout your life.
Oh, by the way, one of the things to keep in mind, this doesn't come into play all the time, but some policies are just written to age 100,
right?
Which is now more of a problem than it used to be because more people are living over 100. So
there is a fine date in there typically, but it's supposed to last you throughout your life.
With that, we're going to take a break. We'll probably end up covering just talking about whole life coverage for the rest of the thing, and we probably won't get as much to the differences. But this is Dave Weaver and Tom Pop with User Friendly Finance. We'll be back right after the break. Give us a call at our office at 706-0700 or via the web at swcwealth.com. We'll be back right after the break. This is Dave Weaver and Tom Pop with User Friendly Finance from SWC Wealth Management. We'll take one more second just to plug our locations and phone numbers. The offices are located in Palmyra and in Carlisle. In Palmyra, we're at 103 West Main. In Carlisle, we're at 35 East High. Both are about a block off the square. Very easy to get to, or you can reach us via the web at swcwealth.com. And our primary telephone number is 717-706-0700. I keep saying that our website will be up and running, which hopefully it will be soon, and that will still be the swcwealth.com. It'll just be hopefully a little fancier and a little easier to navigate, and we should have that up and running shortly. So we're back to the subject of life insurance and the difference between permanent and term, and we were just getting through and trying to start to cover some of what the various components are of whole life insurance coverage. And typically, like we said, the age of the policy, sometimes they go for your life, sometimes they're limited to a certain age. You just want to make sure which way it's rated. We had one lady who was, we did a quote for her to age 100, and she said, that's not long enough. I think, what if I live to 105? Because basically at 100, the policy stops. You have to cash out. It no longer, you basically get your cash value. You don't get the coverage after whatever that last issue age is. So you just want to make sure which way it is. And it can be, the longer you live, the little more expensive the rate is, because they have to cover you for a longer period of time. So the cash component, do you want to just discuss that for a second, Tom?
Yeah, I think that's probably one of the benefits of the permanent life insurance. Is
probably the biggest benefit.
The biggest benefit for sure is that you have that cash value portion that you can build up and also use before you pass away. So it becomes a benefit that you can have when you're living as well. So you basically have two values. You have the face value, which is the death benefit value, and then you also have the cash value as well. And then you can, depending upon if it's a whole life or universal life, you can use that to pay for premiums. You can take a loan from it, which is a tax-free loan, or you can also take money out of the cash value, which is taxable up through the basis or the amount that you put in.
Yeah, one thing that we didn't mention with term or whole life is that the proceeds of life insurance are tax-free.
Right. That's probably one of the best, most tax-free, really, vehicle you can have for money.
Yeah, because we got in this discussion with somebody a couple of weeks ago where they had a variable annuity and assumed that was tax-free as well. But there is a taxable portion of a death benefit that comes from a variable annuity. But for whole life or term life, the proceeds of that are tax-free to your beneficiaries. So a huge tax benefit for them to receive that. the as you're paying premiums in a whole life, typically your policy, you won't see the cash value build up quite as quickly because the way the costs are structured with those, or typically structured with those, there are a lot of upfront costs that are paid with the initial premium. So you don't
Right.
see the cash value grow quite as quickly as you do later. But then eventually the cash or the cost of insurance starts to go up. So you're paying essentially for some administrative charges
Mm-hmm.
that will be higher earlier in the policy, and then some the cost of the insurance you'll see as a separate component. Each year you should get a summary of your policy that'll tell you how much is going towards the cash value and how much is going towards the various components.
Yeah, so with whole life, essentially that caters to long-term goals by offering the purchaser consistent premiums and a guaranteed cash value accumulation. So it's credited with an interest rate credit on the cash value,
Like a minimum
minimum
credit
credit,
rate.
and then you can also get dividends as well within that policy, versus a universal life insurance policy gives you more flexibility in your premium payments, more flexibility, and you can control your death benefits, and the savings element then of your cash you can also invest as well into investment accounts.
And those investment accounts are subject to market fluctuation.
Right.
So similar to what you'd have a variable annuity, or even the investments that you have within your 401k at work, or that you may have, outside of a retirement account. But those assets can go up or down, regardless, depending on what's happening in the market.
Right. So that for more of a conservative individual that just wants a straight death benefit and add a little cash, the whole life is potentially more appropriate.
Right.
So.
And universal life, the part of the problem with universal life is as it was sold over time, a lot of times they were sold at rates that were projected when the policy is developed, and a lot of times they used a higher, years ago at least, they used a higher rate than is now coming to fruition as the policies are maturing.
Mm-hmm.
So some of the policies are actually getting in trouble, and a policy can blow up if you don't return
Sure.
enough within the policy to cover the insurance and the cost of the policy.
And they can be kind of complicated for the average consumer. And if anybody out there does have an old policy or a universal or whole life and they're not really sure, that was set up years ago, we do reviews for that at our office. So.
Yeah, a lot of times when we do a financial plan and somebody has whole life, one of the first things we do is do a review of the policy.
Mm-hmm.
Maybe not the first step, but that's definitely a component of looking at their financial plan to make sure the policy is performing the way they wanted, or the way they expected, that it'll be in place to cover the needs that they've defined when they first got the plan, and try to decide if they need more insurance and whether that additional insurance might be term or whole life. But you want to see if the policy you have is doing what you want.
Right.
Sometimes it is, sometimes it isn't. Sometimes it's, I would say at least half the time, we think that people should stay with the policy that they've got as it was sold. It's performing well, doing what they expected. But the other half is probably policies that may need to be relooked at or replaced.
Mm-hmm. Or it wasn't sold correctly to them, and they're not really sure what they have.
Right.
So just education is part of it too. If anybody has questions about it, we'll help educate you on it.
And variable life insurance, we talked about as we didn't. We talked about universal life.
Yeah.
So variable life insurance is similar to universal life, except the policy holder is allowed to invest the cash in our policy. We did talk about that.
Yeah, it falls under the universal
Right.
variable. That's why there's a lot of different terms out there that can be confusing. But
Right.
Yeah, the downside is that if the policy doesn't perform as well, the returns aren't earned, and hence you end up paying higher premiums. You might have to put more money into the policy to keep it afloat.
Right.
So
And that's where people get dissatisfied with their policies.
right.
Or
So
one
we've
of the
seen
ways.
that before too.
Life insurance typically is on one life, but you can also get that to cover two lives. If you cover two lives, it's typically more expensive than covering one life, because then you have to cover the event that both people are at some point going to pass. So, but there is both it's called survivor.
Survivor or second to die policies. And those were a lot more popular when the estate tax was very low. But, you have, what's the estate tax now?
I don't know what it changed to with the new tax law.
11.5 million or something.
Oh, the limit, the
limit.
threshold is 11.2 million now. So very few people right now, at least the people in our world, a lot of people don't qualify for that, but it's 11.2 for an individual, 22.4 for a married couple.
Yeah.
So a married couple would have to have $22 million of assets before they qualify for federal inheritance tax. But you're right, when that threshold was down around 3 million years ago, that's, people were trying to get insurance to cover that. And
Cover
you would
the
do,
cost of it, yeah.
if you have this situation, you don't want your beneficiaries to be subject to the inheritance tax because it's huge. Anyway, okay, so what other types of policies can we have, Tom?
So we talked about universal life, variable universal life, whole life, term. I think that's primarily the main ones that we cover. You can get group policy through your work, obviously, and there's typically not an underwriting process involved with that. So that's a good place to start if you don't have anything. But it's always good to take a look at your finances and figure out
is life insurance
what you can
appropriate
do.
for you?
Yeah.
So probably in a succeeding show, we'll talk about other benefits of life insurance or how you might use your policies to better enhance your coverage. For now, though, this is Dave Weaver and Tom Pop with SWC Wealth Management and User Friendly Finance. We'll be back next week. Give us a call at 717-706-0700 or via the web at swcwealth.com.
David Weaver, Megan Wall, and Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm.